The Fed is raising rates by 25 basis points, but the market already expected that. So what mattered in today's announcement, Derek?
It was the Fed's view on where the economy is going, the projections on growth, on the policy rate. And when you looked at those, not a huge change. The Fed does see inflation climbing to 2%. In fact, it's almost mission accomplished on that front. Didn't change its economic assumptions very much, has moderate growth in the forecast. But the big thing, did the Fed's views on where it sees policy rates change? And from that standpoint, there wasn't a big change. They still see rates, 3 rate hikes in the equation this year, 2 additional. We've already had 1. 3 rate hikes for next year and a longer term rate around 3%, which is only slightly higher than they had in December. So that's what the market was interested in. Didn't see big change and hence a little bit of jubilation immediately thereafter.
So when you look at this overall, what do you think this suggests in terms of, a more hawkish statement, a more dovish statement? How would you characterize what we heard today? That's
a good question. I would characterize it as more confidence in the outlook. When you look at the survey of projections on rates, it is more clustered around the forecast rather than being very dispersed. So more confidence sort of together, but no higher. So I wouldn't say it's more hawkish, just more confidence in the outlook. And that lines up with its views on growth. Certainly the comments we've heard recently that the economy is doing quite well. It's not booming, but it's got a strong underpinning and doing reasonably well.
And how important do you think it is that the Fed gets the future pacing right? I know you mentioned we're going to see a couple more rate hikes this year, but is there anything that could derail their plans?
There's lots. I mean, there are a lot of risks. I think one thing we saw in their assessment, they're more upbeat on business investment in the United States. And many of us, I know that's been a big theme of ours. If there is an upside risk, the forecast might come from business investment. Certainly inflation, interestingly there, I think markets did like the fact that they don't seem fixated on 2% inflation target, a little bit of latitude around that, talking about a symmetric target. So that's good, but still if inflation obviously climbs more than anticipated, that could lead to a faster pace of rate hikes. Fiscal policy, more stimulus, that's something they don't really embed, at least not many members embed in their economic projections. That could lead to a faster pace. On the downside, we have a lot of things in Europe, globally, that's all the same, and that if we see an outbreak there, that could stay their hand.
So, I mean, taking the global picture into account, I know you touched on Europe, but moving things here to Canada, the Bank of Canada is not expected to do anything really for the next little while. The expectation is they're going to stay on the sidelines until late 2018, early 2019. So how could policy divergence, start to impact projections? Do you think it'll force their hand at all?
I don't think so. I think right now the markets do see a Bank of Canada that's not going to be raising rates anytime soon. There's a small probability of a rate hike built in over the next year, but not a huge one. That's already built in. We've seen the Canadian dollar pull back in recent weeks. I think part of that is this divergent story along with the weak oil price. So I do think they can pull it off. Clearly the Canadian dollar is going to be on its back foot in this kind of environment. We're not going to see any major strengthening unless oil prices surprise us and take another big leap forward, which I don't anticipate in the very near term. So I think they can pull it off, and I think that's certainly consistent with the kind of economic projections we have, a Canadian economy that's going to be underperforming the U.S. and just some more slack in this economy than stateside.
Thank you very much.
Thank you.